Hello and welcome to Coffee Break Accounting with me, Becky Brooksbank. If you haven't already done so, feel free to press pause here, go and grab a cup of tea, coffee or drink of your choice, and then come back and join me for 10-15 minutes of jargon-free accounting support for your business. So, as we've been going through, we're currently on Series 3, Episode 6, and Series 3 is exploring everything to do with beyond the profit and loss account. So Series 1, we looked really in detail at what the profit and loss account was, gross profit margins, net profit margins, how to identify if you've got pricing issues, etc, etc. Series 2, we looked at simple systems and how you can implement the basic systems into your business so that you get number savvy. And Series 3 is taking it a little step further to look at the other financial reports that are common in businesses after the profit and loss account. And we're delving really deep into the balance sheet at the moment. So if you were watching last week's, you will notice we looked at everything cash related. We are sticking with the assets of the business at the moment. So the good things, the things you're owed in or that will give you future benefit. And we are going to look at accounts receivable today. So I always promise that we'll have a little, not too much accounting jargon. So accounts receivable is a bit of accounting jargon, but don't worry, by the end of it, you will understand exactly what it means. So let's have a look. So what are accounts receivable? And I put in brackets here, AR. Let me just move them up a little bit. Apologies for that. What in brackets AR? They're quite commonly known as AR. I'm just going to check my AR. Otherwise known as aged debtors. Okay, so debtors are people that owe you money. So you will see on there that that's another term for it. Okay, so what is an accounts receivable balance? Well, it's a balance that's due to you for goods or services that you've already supplied, already delivered out to somebody, but you've not yet been paid for. Okay, so let's bring in John Tapp, our resident case study guy at this point. We'll think about John and say, for example, he's fitted Mrs. Brown's kitchen and he said, don't worry, you can pay me the last bit of your balance in 7 days time. Okay, so he's finished the work, he's delivered the service of fitting her bathroom for her. He has promised her that she can have 7 days to get the money together and then pay him. So he's offering her credit terms. He's creating an accounts receivable. Okay. Now, Mrs. Brown has a legal obligation to pay that debt to him because she's enjoyed that service. She's got a brand new bathroom and everything else. Okay. So that's what an AR balance is. Now, where an aged AR comes in, so I said aged debtors, it means that the older the debt gets, it's aged. Okay, so something that's new and current, and they will pay hopefully within in your credit terms, that's current, but thereafter, as it falls overdue, it becomes aged. So that's what an accounts receivable is. Okay, so you can see how they're really positive. They fall as an asset because you're going to get the money in. It's going to top up your bank account and give you plenty of money then to go off and pay yourself and pay all your expenses within the business. Okay. Now, what happens? And a really important part of the aged debtors accounts receivable is that there is always a risk when you offer credit terms that somebody doesn't pay. Okay, now this is where you find yourself in the situation of having a bad debt for your business. So this means that, and that a bad debt happens, it will cost your business because you're not going to get that in. You've done the work, you've supplied the goods, all at your own cost. And ultimately, if they don't repay that credit, then it'll be uncollectible. Okay, so it turns bad at the point where you realise that you're not actually going to get that money back from them, or you get 50% and not the other 50%, or whatever it is. Okay, so in essence, what you're doing is you're going to remove the debt that's owed from your accounts receivable, because it's no longer positive for your business, and you're going to show it as a taxable loss to your business profit. So you're going to reduce your profits down by that amount. Now the good news is, I said taxable. Bad debts are allowable for tax, so that means you can reduce your tax bill by writing off a bad debt, so you're not penalised by the tax man if somebody doesn't pay you. Okay, so accounts receivable is money that you have in, and occasionally it does go bad. So what does that look like in our balance sheet? Well, we'll flip over to the next page, hopefully, if my thing works. I'll just move over to here. Now, we have here the snapshot of our balance sheet, and you will see we looked at cash last week, and then we have the accounts receivable balance falling down here, and those form the current assets. Okay, so your AR, accounts receivable, aged debtors will sit within your current assets, i.e. they're deemed recoverable in the immediate future. Hopefully everyone's going to pay you. Okay, now that sits in your balance sheet, and obviously when you get the money in, you'll pay that off and your cash balance will go up, but your accounts receivable balance will go down. So I found here, and it's really important that you figure a way out for your business to track your accounts receivable, i.e. the people that owe you money. Okay, if you're using an Excel spreadsheet, then likelihood is you'll have an invoice column, invoice date, amount, who it's due from, and then a date paid. So when they actually physically pay the bank, you will write it in there. So you can check those ones that you haven't written anything in still need paying. Okay. Now, if you're on accounting software, you will see that one of the real common features is the accounts receivable summary. And I always say to my clients that they should be checking their accounts receivable summary at least once a week. Okay, and I've put an example here. So as you can see down the bottom here, I've cribbed this from Xero using their demo company. So don't worry, there's no client data or anything in here. And this is an accounts receivable summary. So what you'll see is each individual contact coming down here, and then the amount that they owe. So anything in this column is not yet due. Okay. Then it starts to get older. So this was due within the month. That's greater than 1 to 30 days overdue. That is 30 to 60 days overdue. Okay, so you can see, and this way makes it really easy to see who you should be chasing for payment. You'll note here, once you start getting people into 2 months, that bad debt that we were talking about a minute ago, that becomes even more essential to think about. The longer you leave a debt without chasing it or getting it paid, the less likely is that you will ever receive it in. So for me, if this was my business, city limousines would be well on my chase list to try and recover that money. So I always recommend again to my clients that they have a really robust bad debt system in place. So a bad debt system is how you go about chasing those debts, okay? Because the last thing we want to do is you put all that hard work and effort into a job and then you just don't get paid for it at the end, okay? So here's what I recommend, and again, you can adjust this dependent on your business. Some people shorten the length of time, some people slightly extend it, but I was always say make it true and fair for your all customers. So regardless of who the customer are, follow the same process, okay? So it might go something like this. Step 1 is really simple. At the end of start of every month, whenever you want to, at least once a month, send statements to all your customers. Okay, this is really good practice. What that means is you send them a snapshot of what is outstanding as at that day. And if you do that regularly, their accounts team or the business owner will look at it regularly and they will see if they're missing an invoice or they will see if they need to query something with you, but it keeps you fresh in their minds. Okay, the fresher you are in people's minds, the more likely you are to get paid. Okay, so sending statements is just a bit of a chivvy up. And if they've got a good accounts department or a good accountant working with them, or they're a great business owner, they will check those statements to their ledgers and agree it every month. But when that debt starts to fall overdue, so say they don't pay, we need to take some action. And I start off really softly. So when it goes overdue, one day overdue, I'll just make contact with them either via email or a quick phone call saying, oh, have you got my invoice? Is everything okay with it? Have you got any queries? Just so that they know that you're looking at it. And it could be that somebody's put it on the pile to dispute the price or something, and they just haven't got round to contacting you. It could be that it got lost in the email system and it's not even on their system at all. So have a nice softly conversation. Step 3, when it goes 30 days overdue, I would put their account on stop and say, do you know what? I'm really sorry, but you've got an outstanding invoice. I can't do anything further with you until you've paid that invoice. Usually, if they want your goods and supplies, they will pay that invoice and it'll all be fine. You can take the account off stop again. Step 4, if they go 60 days overdue, so remember now they had a month to pay and they've now had another 60 days since they received those goods and services, it's getting a long time now. You're looking at a quarter of a year and you still haven't been paid for that. So at this point, I'd be offering them a payment plan. Now, a payment plan is where you can choose to split the debt down into a number of payments. Okay, so say it's £1,000, you could ask them to pay £500 this month and £500 that month, in the hope that if you break it down, they'd be able to pay for those goods. Now, the reason you offer a payment plan is because later on, if you take county court judgments and take them to court, you have to have shown you've given them chance to pay. Okay, and it could be that you even need to split that £1,000 down into 4 chunks, so 250, 250, 250, 250, or whatever is reasonable. I would always offer them initial, and if they can't afford it, they'll come back to you and say, can we do this? And I would always negotiate with them if you can. Okay, because it's better to get something than nothing. Step 5, if it goes another 30 days overdue or they fail to pay one of the payment plan options and they default on the payment plan, I would issue them a final demand. Okay, and step 4 and 5, I would always do in writing, because there's your evidence that they've had it. Okay, so either via email and try and get a read receipt, or, and what I would probably do as well, is put a registered signed for letter in the post and keep the signed for receipt, just to prove that you have done that and they've signed for it at the other end. So step 5 is to issue a final demand that basically says all the debt needs to be paid by this date, otherwise we will consider taking further action. And that further action is step 6, either going to issuing a CCJ, which you can do yourself online, or you can involve a debt collection agency. My personal, and this is a very personal thing I will tell you, is I always prefer to go down the CCJ route rather than a debt collection agency, because an agency will take a percentage of the money that they get. And it's not necessarily that they're more likely than issuing a CCJ to get it. But it's your decision at the end of the day, and by all means, go and talk to a debt collection agency and see what they have to say about it. Okay, so that is the steps that I would say for you to take for your business if you wanted to reduce your risk of bad debts. Okay. I'm going to leave you with a takeaway task for today. So we've just, remember, our aim was to discuss the accounts receivable, get you familiar with it, give you a bit of an idea of how you're going to chase these debts, and a little snippet of a system. But there are some mathsy bits behind it, and it's really important as well for you as a business. One of your KPIs, one of your key numbers that you should be following on a monthly basis is how long it's taking for you to collect your debts from your customers. Okay, now, rather than me sit here going through all the mathsy side, because I know people process at different stages, the way to do this is there's a great link by Fluidly, which is a cash flow management tool that I use within my business that explains to you how to calculate your debtor days. So your takeaway task for today is learning how to calculate your debtor days. If you click on the link here, it will take you over to read it and you can learn from there. So you can see, compared to what your credit terms are, how long it really takes for your customers to pay. Okay, next week we are going to look at accounts payable. So today we've looked at accounts receivable, things you're due in. We are going to look at accounts payable, which are payments you have to make out. So thank you very much, everybody, for listening to this week's Coffee Break Accounting. I will see you next week for our next instalment. Take care. Bye for now.